Okay, guys, we've headed cost of capital, right? So we know most of the things in this particular reading, right? So basically, guys, there are three ways in which we can raise capital, right? Three ways in which we can raise capital. First is your common equity. Next is your preferred equity, and last is your debt. Right. So these are the three ways in which a firm can raise capital to finance its operations to fund the purchase of its assets. Right. Common equity, preferred equity, and debt. And we've already discussed the characteristics of common equity, preferred equity, and debt. But I'll quickly summarize it. Right. Okay. So we'll just quickly summarize it. Now, guys, are debt holders of the company the owners of the company? Please tell me. Are debt holders the owners of the company?
No.
No. Are pref equity holders the owners of the company? No. Common
No.
equity shareholders are the owners of the company. Right? Who have the voting rights?
Only preferred. Common.
Debt holders do not have voting rights. Pref equity shareholders do not have voting rights. Only common equity shareholders have voting rights. A priority in payment of interest and dividend. First priority is to pay interest on debt. Second priority is to pay preferred dividends, and the last priority is to pay common dividends. Right? Okay. Now, whether interest and dividend are fixed or variable. So we know that interest on debt is payment of interest on debt is fixed in nature, right? You have to pay a fixed interest every year, and if you do not pay this interest, you will be a defaulter. It's a contractual obligation, right? So you have to pay a fixed interest every year. It's a contractual obligation. If you don't pay so, then you are considered a defaulter, and that could have a very adverse impact on your credit rating. That could have a very adverse impact on your stock price. Okay. Now we know that common equity payment of common dividends is variable. It varies with the earnings of the company, and payment of common dividends depends upon the discretion of the management, right? And guys, what was about pref dividends? Are pref dividends variable or pref dividends fixed? Hello? Are pref dividends variable or are pref dividends fixed?
Variable.
So see, pref dividends are a fixed percentage of the par value of the preferred share. Right? This is something that we have discussed. It was a fixed percentage of the par value of the preferred share. It's a fixed percentage of the par value of preferred share. But we had discussed that if the preferred share was cumulative, any shortfall in the current year would be paid in the future
Next.
year. And if it's non-cumulative, any shortfall in the current year is not paid out in future years. Right? So this is how the preferred equity works. Payment of interest is fixed because it's a contractual obligation. If you do not pay, then you would be defaulting on the debt agreement, and payment of dividends to common equity shareholder is variable, varies with the earnings of the company, and depends upon the discretion of management. Payment of common dividends depends upon the discretion of the management, and we've already discussed how preferred equity dividends work out, right? How they are paid. Okay, right, guys. So the next point that we need to cover is that, guys, tax deductibility. Is interest on debt tax deductible, guys? Is interest on debt tax deductible? Yes, it is. Are dividends tax deductible? They reduce your tax outflow? Do preferred dividends reduce your tax outflow? Do common dividends reduce your tax outflow?
No.
Right. So in the previous session itself, we had discussed this, that you know interest on debt is deducted from your EBIT to calculate PBT. Right. Interest on debt is deducted from your EBIT to calculate your PBT. So interest on debt reduces the PBT, which in turn reduces the tax expense, right? Which in turn reduces the tax expense, because your taxes are calculated on the basis of your PBT, right? So interest on tax debt is tax deductible. It reduces our tax liability. It results in tax savings, right? Interest on debt results in tax savings. Okay, so once we deduct tax from PBT, what do we get? We get income from continuing operations. Okay, now are preferred dividends tax deductible? No, they are not tax deductible. They do not reduce our PBT. Where are preferred dividends shown in the income statement? Guys, where are they shown on the income statement? Okay, so to our income from continuing operations, we add income from discontinued operations, net of tax, and when we add the two, that gives us the net income. From our net income, we deduct pref dividends, and once we deduct pref dividends from net income, what we get is income available to common equity shareholders of the company. Right. So, are preferred dividends reducing my PBT, guys? Please tell me. Are pref dividends reducing my PBT? Guys, please tell me yes or no.
No.
Hmm?
No, sir.
Pref dividends are not reducing my PBT, and since they are not reducing my PBT, they are not reducing my tax expense, and since they are not reducing my expense, they are not tax deductible, right? Pref dividends are not tax deductible. And lastly, common dividends. Where are common dividends reported in the financial statements, guys?
Balance sheet retained earnings
Yes.
and
So they are
retained
not
earnings.
reported in the income statement in the first place. Common dividends are deducted from my retained earnings, which is a part of the stockholders' equity. So my retained earnings, to the opening balance of my retained earnings, I would add the income available to common equity shareholders, and we'll deduct dividends paid to common equity. So since dividends paid to common equity do not feature in the income statement, there is no chance that they would reduce my PBT. So there is no chance that they would reduce my PBT, right? So dividends to common equity shareholders are not tax deductible. They do not result in any tax savings, just like preferred dividends. They too do not reduce my PBT, and since they do not reduce my PBT, they do not reduce my tax outflow. They do not result in any tax savings. It's only interest that we pay on our debt that reduces my PBT, that is deducted from my PBT, results in a lower PBT, and a lower PBT in turn results in a lower tax expense, right? So it's your interest on debt that reduces your tax liability, results in tax savings, right? So these were the many characteristics that we already know, but I summarized it as soon as possible. Okay, there are other as well, guys. There are other characteristics that we need to discuss. Now we've already discussed this, and in the event of the liquidation of the company, first priority is to repay debt holders, second priority is to repay preferred shareholders, last priority is to repay common equity shareholders, right? Okay. Now guys, from the investor's perspective, investment in which instrument is least risky? Debt, pref equity, or common equity? From the
That
perspective of the investor, yes. From the investor's
okay.
perspective, debt is least risky. Debt
Okay.
is least risky from the perspective of the
Invest.
investor, right? And why is this so? Because investors in the debt of the company have the topmost priority when it comes to payment of interest, and debt holders are repaid first at the time of the liquidation of the company, right? So they are repaid first at the time of the liquidation of the company, and at the, when it comes to payment of interest, they are the first to receive payment of interest, right? Dividends to preferred shareholders and common equity shareholders are paid after we pay interest on debt, right? So that is why debt investment from the perspective of the investor is considered to be least risky, right? Then pref equity, and lastly, your common equity is most risky, right? Common equity is more risky, right? So we can say that your debt, lowest risk, your pref equity, when you move from debt to pref equity, your risk increases. So we can say moderate risk, and common equity, highest risk, right? And why is common equity most risky, guys? Or why does common equity investment carry the highest risk? So the reasons are
They
that
paid in the end.
yes, payment of common dividends is variable, it's not a contractual obligation, and it's the it has the lowest priority. For the company, payment of common dividends has the lowest priority, and in the event of the liquidation of the company, common equity shareholders are the last to be repaid, right? So that is why common equity is the most risky investment when we speak from the investor's perspective. And why are preferred shareholders said to be preferred over common equity shareholders? We've discussed this hundreds of times. Preferred shareholders are said to be quote preferred because preferred dividends are paid before common dividends, and the second reason is that in the event of the liquidation of the company, claims of preferred shareholders, that is the capital invested by preferred shareholders, are paid before common equity shareholders. So this is the broad idea with respect to debt, equity, and preferred equity. Right now, I'll tell you how to calculate the cost of debt, how to calculate the cost of equity, how to calculate the cost of preferred equity. Right. So we'll have debt, equity, common equity, or not rather common equity. Let me write preferred equity. and lastly we have common equity. Guys, those who invest in the debt of the company are known as the debt holders of the company, right? Those who invest in the preferred equity of the company are known as preferred shareholders. Those who invest in the common equity of the company are known as common equity shareholders, right? And these people will only invest their money in the company. They will invest in their money in the company if the company pays them something. They are not going to invest for free. So what the company needs to pay to its debt holders is a cost to the company and is known as cost of debt. What the company needs to pay to its preferred equity shareholder is again a cost to the company and is known as cost of preferred equity. And what the company needs to pay its common equity shareholders is known as cost of common equity. Guys, out of all these costs, only my cost of debt would reduce my tax liability. So only my cost of debt is tax deductible. This, it's only the cost of debt that reduces my tax liability, that results in tax savings. Cost of preferred equity and common equity are not tax deductible. They do not reduce my tax liability. Okay. Now guys, how do we calculate the cost of debt? Cost of debt is the YTM of the bond into 1 minus tax rate. Right, YTM is the before tax cost of debt. We are multiplying it with 1 minus tax rate. Why? Because it cost of debt is tax deductible. How do you calculate cost of preferred equity? It's nothing by D0 by P0, where D0 is the dividend that a preferred share pays and P0 is the price of the preferred share. And there are two ways to, that there are two ways that are given in the syllabus as to how to calculate cost of common equity. First, you calculate it using the CAPM model, which says that required return by common equity share required return by common equity shareholders, or cost of common equity for a company, is RF plus RM minus RF into beta. And the second method that has been suggested in our CFA syllabus to calculate cost of common equity is the bond yield plus risk premium approach. Right. So this is the broad idea. Now guys, we'll address cost of debt as KD. Right. KD is YTM into 1 minus tax. We'll address cost of preferred equity as KP. We'll address cost of common equity as KD. Right. Okay. Now the name of the reading is cost of capital. Right. So the goal here is to calculate the weighted average cost of capital. Short short for this is WACC. Now what is WACC? It's the average cost of raising capital from these three sources of financing. It's the average cost of raising capital from these three sources of financing. And how would we calculate this? Is how do we calculate the weighted average cost of capital? So we calculate the weighted average cost of capital as weight of equity into cost of equity plus weight of debt into cost of debt plus weight of preferred equity into cost of preferred equity. Right? This is how we calculate the weighted average cost of capital. It's the average cost of raising capital from these three sources of financing. Now, what is WE? It's the proportion of total capital that is funded through common equity. Similarly, weight of debt is proportion of total capital that is funded through debt, and WP is proportion of total capital that is funded through pref equity. Okay. No, but guys, this calculation is not as easy as it seems, right? So we'll have to understand as to how to calculate these weights, right? We need to understand how to calculate these weights. So let us understand this first. Okay. Say the current capital structure of the company, say name, let's name the company as XYZ, is something like this. This is the balance sheet of XYZ. Book value of common equity is 100. Book value of preferred equity is 100, and book value of debt is 100. So total capital is 100 plus 100 plus 100, 300. Right. So guys, we'll calculate the weight of debt, which is how much? 100 by 300. That is 33.33. Weight of common equity is also 33.33. Weight of debt is also 33.33. Right. So these are the book value weights as per the current capital structure of the company. Right. These are the book value weights as per the current capital structure of the company. Now we cannot use these weights for the calculation of WACC. We should use the weights which represent the target capital structure of the company. So say this company XYZ is doing, okay, so please note this down. We cannot use these weights for the calculation of the WACC. We cannot use the book value weights. We cannot use book value weights as per the current capital structure of the company to calculate WACC. We use the weights which represents the target capital structure of the company. So I'll explain this with an example. Now say this company XYZ is going to do a new project for which it requires additional capital of 100 million. So it plans to raise the entire 100 million by issuing debt. It plans it plans to raise the entire 100 million by issuing debt, no common equity, no pref equity, right? Okay, so post issuance of the debt, the capital structure of the company would look something like this. Book value of debt would become, guys, how much? Book value of debt was previously 100. The company raises another 100 to fund a new project. So book value of debt is 200. Book value of pref equity remains unchanged at 100, and book value of common equity remains unchanged at 100. Total capital 400. Now guys, calculate the weight of debt. Guys, please calculate the weight of debt. Weight of debt would be how much now? 200 by 400.
200 is 400. 20.
50%. Book value of preferred equity would be 100 by 400. That's 25%. And weight of preferred equity would be 100 by 400. And weight of common equity would be 100 by 400. That is 25%. Right. So these are the weights which are suggested by the target capital structure of the company, right? These are the weights that are suggested by the target capital structure of the company. So book value weight of debt is 50%, book value weight of preferred equity is 25, book value weight of common equity is also 25. So these are the book value weights represented by the capital structure the company wishes to achieve, and the capital structure the company wishes to achieve is known as the target capital structure of the company. Right? This is the target capital structure of the company. This is the capital structure that the company wishes to achieve. Right. So we'll use these weights in the calculation of WACC. Right. We'll use these weights. And what do we call these weights? These weights are book value weights represented by the target capital structure of the company. And what is the target capital structure? Target capital structure is the capital structure that the company is trying to achieve. Right? It's the capital structure that the company wishes to achieve. Right? Now, guys, as analysts, as company outsiders, one may not know how the company is going to raise capital for funding a new project, whether it will raise debt, whether it will raise common equity, or whether it will raise preferred equity to fund this project. So, as analysts, we may not know the target capital structure of the company, right? Who decides whether we'll issue debt to raise this 100 million, or we'll issue preferred equity, or we'll issue common equity? The management decides, right? And as analysts, as company outsiders, we can't look into the minds of the management. We can't read the minds of the management, right? So, as company outsiders, as analysts, we are not expected to know the target capital structure of the company. And in such a scenario, when we do not know the target capital structure of the company, what weights should we use for calculating WACC? Okay, so in this case, we should, in this case, when we do not know the target capital structure of the company, we use the market value weights as per the current capital structure of the company. Okay, so market value weights as per the current capital structure of the company. So you might be wondering, what do I mean by this particular term, right? So let's understand this with the help of an example. Say, guys, the market value of common equity, or the market capitalization of the company, is 105 million. Market value of, say, company's bonds or company's debt is 95, and market value of preferred equity is, say, 100. Right? So market value of total capital of the company is 300. Right? Guys, now let us calculate the uh, market value weight of debt. Market value weight of debt is how much? Please calculate. How will you calculate this? 95 by 300.
300.
Market value weight of common equity would be
105 by 300.
105 by 300. 105 by 300 is around 35%. 95 by 300, जल्दी बताना मेरे को क्या है. And market value weight of uh, pref equity would be 100 by 300. This is 33.33. 95 by 300 is how much?
0.317.
31.67. Right. So if we add the 3, we'll get 100%. So, guys, in case the analyst does not know the target capital structure of the company, he should use the market value weight of debt, common equity, and preferred equity while calculating the WACC. I hope all these things are clear, guys.
Sir, just one thing, like getting the data for the how much capital they are raising through debt in an organization, it is very difficult, right?
Which data?
Like if I want to know that the company is using how much debt and how much equity,
Mm-hmm.
uh, so getting the data for the how much debt means they are raising from various uh,
So we won't know how they are going to, how the company is going to finance a new project. We won't know this, right?
right.
That is something privy to the management of the company. That is something that the management of the company would decide. So as analysts, we may not know how the company would finance a new project. That
Hmm.
is another way of saying that the analyst won't know the target capital structure of the company. And when the analyst does not know the target capital structure of the company, we should use the market value weights of debt equity and preferred equity to calculate the weighted average cost of capital. ठीक है ना?
Okay.
So guys, please write this down. We do not use the, please write these three sentences down. This is very important. We do not use the book values of, we do not use the book value weight of debt, equity, and common equity as per the current capital structure of the company. We do not use the book value weights of debt, equity, and preferred equity as per the current capital structure of the company to calculate WACC. We use the book value weights suggested by the target capital structure of the company. We use the book value weights suggested by the target capital structure of the company. Then write, what is the target capital structure? Target capital structure is the capital structure that the company is striving to obtain. Target capital structure is the capital structure that the company wishes to obtain. Third, please, guys, are we noting this, please? Yes or no? Are we noting this or not?
Yes, sir.
As company outsiders, as analysts, as company outsiders, analysts are company outsiders. So, as analysts, as companies outsiders, we may not know the target capital structure of the company. And when we do not know the target capital structure of the company, we should use the market value weights of debt, equity, and preferred equity. We should use the market value weights of debt, common equity, and preferred equity suggested by the current capital structure to calculate the WACC. Guys, are we good? Is all is everything crystal clear, or do we have any doubts?
Okay. Okay, sir.
Anmol, Ankit, uh, Dhwani,
Good, sir.
Good, sir.
Good, sir.
Sankush, सब clear? ठीक है.
Yes, sir.
Okay, so now guys, we'll start with the calculation of cost of debt. You already know this calculation. You already know this calculation, but I'll just revise it. But before that, a very important point, guys. Please write this down. This is a very, very important point. See, when we calculate the cost of debt, preferred equity, and common equity, we calculate the cost at which we can raise fresh debt, the cost at which we can raise fresh preferred equity, the cost at which we can raise fresh common equity, and not at the rate at which they were raised in the past. Right? We will calculate the rate at which we can raise fresh capital and not the rate at which capital was raised in the past. This is a very important point. Right? So, so if you had raised debt at a cost of 8% some 1 year back or 2 year back, that 8% won't feature in the calculation of your weighted average cost of capital, right? If you had raised common equity at 12% in the past, we won't use that 12% in the calculation of WACC. What will we use? We will use the rate at which we can raise fresh common equity today. We will use the rate at which we can raise fresh debt today. We'll use those rates in the calculation of WACC. And this is why sometimes, the weighted average cost of capital is also known as the marginal cost of capital. Marginal cost of capital basically means the cost of raising additional capital, right? That is why WACC is sometimes known as the marginal cost of capital, that is the cost of raising additional capital. Guys, is this point clear? Guys, are we good here?
Yes, sir.
Okay, so let's now quickly take an example. Guys, I hope we are clear with the CAPM model. Do I need to explain the CAPM model again?
No, sir.
We've done this a number of times. Dhwani, do I need to explain the CAPM model again, or is it good? Okay, so we'll just discuss how to calculate the cost of debt. Okay, so guys, company issues a 5-year bond for rupees for dollars 95, for dollars 95 at a coupon of 5% payable annually, and par value of the bond is dollars 100. Okay, so what are the cash flows involved in this particular transaction, right? So guys, at issuance, what will happen is that the issuer or the company would sell or issue one bond to the investor, and the investor would pay the issue price of the bond to the company. Issue price is $95. Right. So this is what happens at the issuance of the bond. The company would sell one bond to the investor, and investor would pay the issue price for the purchase. The issue price in this example is 95. And guys, every year for the next 5 years, company would pay $5 interest or $5 coupon to my investor, and at maturity of this bond, that is at the end of the 5th year, the company will repay the par value of the bond to the investor, right? So for raising this $95, company has to pay $5 at the end of year 1, $5 at the end of year 2, $5 at the end of year 3, $5 at the end of year 4, and $105 at the end of year 5. So guys, the cost of raising this $95 is can be calculated as follows. 95 is equal to 5 by 1 plus um, KBD. Now this BD is your KBD is your before tax cost of debt, right? It's your before tax cost of debt. 5 by 1 plus KBD to the power of 2, 5 plus 1 plus KBD to the power 3 plus 5 by 1 plus KBD to the power 4 plus 105 by 1 plus KBD to the power of 5. Right, so this KBD, if we solve for KBD in the following equation, we'll get the before tax cost of debt. So guys, use your financial calculators to calculate this. How will you calculate? N equals 5, PV equals 100, PMT equals 5, PV equals minus 95, CPT I by Y.
6.19.
6.19, right? So the basic intuition is that the cost of raising $95 to the company is 6.19% per annum. And this is nothing but the, what do we call this 6.19? This 6.19 is the YTM of the bond, yield to maturity of the bond. Now, what is yield to maturity, guys? Any idea what is the yield to maturity of the bond?
Means what is the value we are getting for holding the bond for the 5 years?
So, if the investor were to buy this bond today at $95 and hold the bond till its maturity, he will make a return of 6.19% per annum. Right. So, please write this down. YTM intuition is, if the investor were to buy the bond at the current market price of $95 and hold it till maturity, he will he will make a return, or he will realize a return of 6.19% per annum. Right. So this 6.19 is nothing but the YTM of the bond. Right. And if we speak from the company's perspective, that basically means is, what the intuition of this 6.19% is, that the cost of raising $95 today is 6.19% per annum for the next 5 years. And if we speak from the investor's perspective, if the investor were to buy the bond today at the current market price of 95 and hold the bond till the maturity, he will realize a return of 6.19%. So this YTM is the before tax cost of debt. This YTM of the bond is the before tax cost of debt. But guys, we know that interest on debt is, guys, interest on debt is tax deductible, right? The company would save taxes when it pays interest. What would be the tax saving to the company, guys? Guys, what would be the tax saving in the out to the company? How will we calculate the tax saving? Tax saving would be before tax cost of debt into tax rate. This would be the tax saving to the company. So, guys, the cost of debt, or the after tax cost of debt, can be written as, so your before tax cost of debt is YTM. So this tax savings can be written as YTM into tax rate. So your after tax cost of debt is YTM minus the tax savings, which is YTM into tax rate. So if we take YTM common, what we get is that the after tax cost of debt is YTM into 1 minus tax rate. Guys, are we good here? Have we understood this? Any doubts here, guys?
No, sir.
Say the tax rate of the company is 30%. Then calculate the after tax cost of debt.
4.33.
So that's 6.19 into 1 minus 0.3, which is 6.19 into zero point 0.7. कितना आ रहा है सुप्रतीक?
4.33.
4.6. Now, guys, say this bond has been issued in the market. This bond has been issued in the market, right? And once the bond has been issued in the bond market, its prices will fluctuate with the market conditions. Its prices will fluctuate with the inflation. Bond prices would fluctuate with the changes in the credit rating of the issuer. Now, due to some reason, the credit rating of the issuer has been upgraded. Right? Credit rating of the issuer has been upgraded. So, how will this credit rating upgrade impact the price of the bond? Guys, how will this impact the price of the bond? The bond was issued at 95. Post issuance, what happened was that the issuer's credit rating was upgraded. How will this upgrade impact the price of the bond? Will it increase the price of the bond or will it decrease the price of the bond?
It will decrease the price of the bond.
The credit rating has been upgraded. Guys, it's a good thing or bad thing? Upgradation of credit
Good thing.
rating is a good thing or a bad thing?
It's a good thing.
Thing.
So why should it decrease the price? It should increase the price, no?
But it will decrease the interest on debt, right?
Yes, it will decrease the interest on debt, but it will
Okay,
increase
okay, got
the
it, got it, got it,
it
got
will
it. Sorry.
increase the price of the bond, right? So say because of a credit rating upgrade, what happens is that the price of the bond increases to 98. Right, previously we had issued it at 95, now it's 98. Now guys, now calculate the YTM of the bond. Now calculate the YTM of the bond, right? How will we do so? 98 equals 5 by 1 plus YTM to the power 1, 5 by 1 plus YTM to the power 2, 5 by 1 plus YTM to the power 3 plus 5 by YTM to the power of 4 plus 105 to the by 1 plus YTM to the power of 5. And guys, the KBD term that I had used here is nothing but the YTM, right? This KBD here is nothing but the YTM. Now guys, calculate the YTM. So in your financial calculators, just replace uh, PV from minus 95 to minus 98. How much do you get? Please tell me.
5.46.
5.46. So my I by Y or my YTM or my before tax cost of debt has reduced from 6.19 to 5.46. Why has my cost of debt reduced, guys? Why has my cost of debt reduced?
Because the credit rating improved, so the risk for
Yes,
the
because the credit rating of the company has improved, the company's debt has become less risky, and now investors would be happy with only 5.46% return, right? Why? Because our debt, the company's debt has become less risky. And the basic intuition is, guys, you know, since the general idea is that the riskier the investment, higher the return demanded by the investor, and lower the risk, lower the return demanded by the investor. When the you know since the company's debt has become less risky, investors are now happy with a lower return of 5.46%, right? And guys, the idea is that if the company were to issue new debt today, if the company were to issue new debt today, it would be able to raise it at what cost? At 6.19 or at 5.46?
5.
5.46.
Yes. So now my cost of debt has changed. Now my before tax cost of debt has changed to 5.46%, right? Because remember the idea, what did I tell you? I told you that cost of debt is not the cost at which we raised capital in the past. Cost of debt, cost of preferred equity, cost of common equity is the rate at which we can raise capital, now, right? Not at the rate at which we can, at not the rate at which we raised capital in the past, right? So in the past we may be raising capital at 6.9%, but if I were to issue debt today, I will be able to raise it at 5.46%. So this would be my before tax cost of debt. And what would be the after tax cost of debt?
3.82.
5.46 into 1.7, 1 minus zero point 0.7, which is 3 point kitna Ankit?
82.
Yes. 5.46 into 1 minus, sorry, 1 minus 0.3. 1 minus 0.3, which is my tax rate. 1 minus 0.3, which is my tax rate, which is 3.87. So, due to the rating upgrade, my after tax cost of debt has reduced from 4.33 to 3.8. क्या बोल रहा है सुप्रतीक? ओके,
तो ऑफिस जल्दी जाना है अभी।
मेरे को भी निकलना है, तो गाइज मैं भी जा रहा हूँ, राइट? आई विल ऑल्सो टेक